Hi, Assalamualaikum madam. My name is Anishada binti Anwar. So today my friends and I would like to present about the concept and its effect in exchange rate. So I'm going to start first. What is exchange rate? Exchange rate is the price of one currency in terms of another currency, or simply the quantity of one country's currency that can be purchased for a particular amount of another country's currency at any given time. The effective exchange rate, which considers all taxes, commissions, and other fees that the public must pay to complete the transaction and receive the foreign cash. Generally, it differs from the reported rate. For example, if 1 US dollar is equal to 10,000 Japanese yen, then the dollar exchange rate is 10,000 yen. As a matter of accounting, if something costs 30,000 yen, it will immediately cost 3 US dollars. Now I would like to look at spot rate. Spot rate is the current rate at which one currency can be exchanged for another at a certain point in time. It is the price where a trader will pay to purchase another currency on the open market. In general, the worldwide forex market, where corporations, countries, and currency dealers settle financial transactions and investments. Attached here is the worldwide forex market. With trillions of dollars transacted every day, forex is the world's most liquid market. We can see that the US dollar, the British pound, the Canadian dollar, the euro, and the Japanese yen are the most traded currencies on the worldwide forex market. Therefore, customers or other banks would acquire significant amount of a currency from any banks quoting low price and sell it quickly to a bank quoting a high price in the event of huge discrepancy. This will result in changes in exchange rate quotations, which will help to close the gap.
So today I'm going to be talking about the forward rate. What is forward rate concept and the purpose? The forward rate concept and purpose are exclusively used when talking about the purchase of treasury bill, more commonly known as a T-bills. Forward rates are calculated to determine the future value. It is the exchange rate negotiated today between a bank and a client upon entering into a forward contract agreeing to buy or sell some amount of foreign currency in the future. Two primary functions of forward market are hedging and speculation, and the effect it enables the investor to choose the investment option, buying one T-bills or two, that offers the highest probable profit. The truth, notwithstanding, is that loan costs might just move when the financial banker folds the principal T charge interest into the second. Every one of the financing cost computations will be somehow and somewhat extraordinary. The actual calculation of it is rather complex. So next I'm going to be talking about the spot exchange rate versus forward rate. So the spot rate is the cost a transacting commodity on the spot. On the other hand, the forward rate is the settlement of a transaction cost that will be settled at a subsequent date. For example, the forward rate is the predefined yield generated by the interest rate and bond maturities in the bond market, a quote buy or sell price of the currency, stock, or commodity for effective delivery, and a settlement on the spot date is referred as the spot price. The forward rate of a bond will be higher than the interest rate if a trader buys that is closer to the maturity. For instance, a trader buys a 2-year bond worth $1,000 with 10% interest rate and 1 year due to maturities. The expected yield or forward rate will be 21% since the investor will receive $1,210 in a year. In general, the forward rate in currency market refers to the agreed upon exchange rate for the future, whereas the spot rate indicates the instrument's current exchange rate.
Now let's move on to the next exchange rate, which is swap rate. It is the agreed upon fixed rate for a swap by contracting parties. A receiver seeks compensation from a payer to compensate in the floating rate used in a swap. This brings me to the next cycle, which is swap rate in interest rate swaps. It involves the swapping of a fixed interest rate for a floating interest rate and usually calculated using the value of changeable index, such as London Interbank Offer Rate, LIBOR, plus or minus rate. LIBOR is the global reference rate for unsecured short-term borrowing in the interbank market. It acts as a benchmark for a short-term interest rate. It is used to establish the entire value of the swap's fixed leg. The fixed rate remains unchanged until the swap's maturity. Next, swap rate in currency swaps. Currency swaps are a popular sort of swap, just as interest rate swaps. It can take a variety of forms and fixed versus floating rate currency is one of them. It is associated with the fixed leg of a currency swap. It generally used as an exchange rate to convert primary notional amounts set in various currencies. Prior to the start of the swap contract, the principal notional quantities are defined. The reference rate is fixed until the swap matures, much like an interest rate swap.
Is hedging. The concept of hedging it deals with reducing or eliminating the risk of uncertainty involved derivative, such as option and future contract, a derivative or a contract whose value is measured by an underlying asset. Hedging generally aims to leave strategic options open without the need to choose balancing or bandwagoning. This concept contributes to explaining variation in states of behavior, particularly among secondary powers, thus honing the analytical edge of the balance of power theory. The effect of hedging may reduce cash flow volatility, reducing the cost of the financial distress, and thereby alleviating the underinvestment problem.
Let's proceed to arbitrage. So, arbitrage can be used whenever any stock, commodity, or currency that may be purchased in one market at a given price and sold in another market at the highest price. So, this situation creates an opportunity for a risk-free profit for the trader. Arbitrage also provide a mechanism to ensure that the price do not deviate from fair value for a long period of time. So for an example, okay, let's say that one of the stock of the company X is trading at $50 on the Kuala Lumpur Stock Exchange, which is KLSE lah, while at the same time it is trading for $50.60 to the Singapore Exchange, SGX. Okay, so a trader can buy the stock on the KLSE and immediately sell the same share on the SGX, so that they're earning a profit of 60 cents per share. So the trader can continue to exploit the arbitrage until the specialists on the KLSE run out of the inventory of the company X stock, or until the specialists on the KLSE or SGX adjust their the prices to wipe out the opportunity itself. Okay, so now let's proceed to the speculation. As purchases on investment, they are always focused on the price that always fluctuate, while the risk associated with the investment is high. The investor is typically more concerned about the generating profit based on a market value change for the investment lah, than on the long-term investing. And when the speculative investing involves the purchase of a foreign currency, it is known as a currency speculation. For an example, as a real estate, they can blur the line between the investment and the speculation when buying a property with the intention to rent it. Okay, while this would qualify as investing, buying multiple condominium with a minimal down payment for the purpose of reselling them quickly at a profit assumed as a speculation. So lastly is a conclusion. On this topic, we already know that the transaction purchase and take place at the some price are calling as a exchange rate. So the rate are between these two different is a money trade. we also learn the modus operandi on the exchange rate, such as spot rate, forward rate, swap, hedging, arbitrage, and lastly speculation. That's all from us. Thank you.